Good afternoon, all. I'm Raymond Dahlman, president of DSA Financial Group, and it is the weekly wrap-up for December 10th, 2021. Hope everyone had a fantastic week out there, and definitely got some snow here in Colorado. I know most of y'all were quite concerned about our snow problem. The people in Denver this week, or the last few weeks, have been freaking out because it's the latest in the year without snow. So, yes, we have snow. Well, it was falling. It's probably about this deep. So, and there's some deer out across the street walking around. So quite exciting. So, anyways, all right. Well, like I said, hope everybody had a good week. If this is your first time watching, be sure to like, subscribe, and share with friends and family. And let's go ahead and dive into what's going on in the world. So, all right, let's first take a look at how the indexes did for this week. The Dow Jones was up approximately 4.12%. S&P 500 about the same, 4.18. NASDAQ looks like it was up about 4.41%. Dow Utilities looks like it was up about 2.09, and the Dow Transports, let's see here, looks like they were up about just under 3%. So not a terrible day or not a terrible week for the markets. Everything looked like it was up, especially the Dow and the S&P 500 both look pretty good. So, all right, well, let's go ahead and take a look at the dailies. The Dow Jones today was up 0.6, the S&P up 0.95, NASDAQ up 0.73. Small caps were down 0.48. The VIX went down 2.89 points, down to 18.69. So that's a good level for the volatility index. So it appears that the traders in the market aren't nearly as concerned today as they were a week ago. All right. And as far as the rest of the world, I see a lot of red across Europe here. And same thing over in Asia, because the last couple of days we would have red in Europe and green in Asia. So looks like we're the only bright spot today in the markets. So, all right, well, let's take a look at the jobless claims numbers that came in for this week. Jobless claims came in at 184,000 versus a forecast of 215, so beat the forecast there. Last week's numbers were revised up from 222,000 to 227,000, although still below what the forecast was for last week. Continuing jobless claims came in at 1.992 million. Forecast was 1.9 million, so 92,000 over forecast. Last week's numbers were revised down from 1.956 down to 1.954 again, and that last week came in below forecast, which was certainly good. All right, the job openings and labor turnover survey came out this week, and there are 11.033 million jobs available. The forecast was only 10.369, so off by about 700,000. And you know, as far as the statistics, as I understand it, there's about a 3 to 4 million person gap between the openings and the people looking for work. So there's a bit of a disconnect there right now. So we'll see if this improves over the next few weeks. Maybe by the time the January numbers come out, we'll see if that has improved. All right, the U.S. Consumer Price Index came out, what was it, yesterday? Or no, today. Came in at 6.8%. The forecast was 6.8. As you can see, the inflation numbers have just been climbing and climbing and climbing this year. So we were at, under 2% in March, and we crossed over into the April numbers, and it has been a steady climb the last few months. So going back, it's the last time we were above 2% was March through December through March, from the end of 2019 into 2020. So, the inflation is kicking us in the butt pretty hard, some more than others, but we'll see if this trend continues, especially if the Fed, stays true to their word and they do start, actually ramping up or reducing their bond purchases. And as long as they stick to that, I think things will be better in the long run, but we'll certainly see. The consumer sentiment numbers came out this week or today. The actual number came in at 70.4. The forecast was 67.1. So that is a pretty decent jump over the last few weeks. So because we were down in the 60s for November, and we've jumped up to 70. So we feel better if we were up in the 80s like we were in the summertime. But it is certainly improving. So it would be nice to get back to close to that 100 number where we've been hugging the last few years. So it's going to take some time. All right, and then the oil rig count. I know I review this every week. We're up to 471 rigs online. That's a 4 rig improvement from last week and the week before. So in the last month, we basically increased the rig count by more than 10. So that should be helping out at the pumps. I know I've seen gas and diesel have receded in price over the slightly. I mean, it's not huge, but it's no longer climbing. All righty. Well, I have a couple articles I want to go through, and hey, I'm doing good on time. I'm only at 6 minutes. All right, this first one is real short. It's 5 things most Americans don't know about Social Security, written by Vance Riga. This was published December 4th, so I saw this when I was farting around on the internet this week. All right, so let's jump in. So you think you know all you need to know about Social Security? If so, congratulations, you're in the minority when it comes to knowledge of the nation's biggest retirement benefits program. A new study released by the Nationwide Retirement Institute found that most Americans are sorely lacking in knowledge about the most basic functions of Social Security. The study, based on a survey conducted by the Harris Poll on behalf of the Nationwide Retirement Institute, part of the Nationwide Insurance and Financial Systems Company. It's indisputable that Americans across all generations need more Social Security education. Tina Ambrosi, Senior Vice President of Strategic Customer Solutions at Nationwide, said in a press release, unfortunately, failing to close the knowledge gap and correct some of these misconceptions can have costly repercussions. Financial professionals must help their clients understand this bedrock of retirement security. Yeah, bedrock. It's going to run out of money in like 4 years. In America, and plan properly to maximize their Social Security benefit. Here are 5 things most Americans don't know about Social Security. Eligibility age. 2 in 5, or 39% of respondents, don't know the eligibility age to receive full benefits. Payments. Just more than half of those not already receiving Social Security, 51%, don't have a clear sense of how much they will get in Social Security income. Third, spousal and child benefits. 30% did not know that Social Security may offer benefits for spouses or children. Inflation protection. More than a third, 37%, incorrectly believe that Social Security benefits are not protected against inflation. And last, no adjustments. 45% mistakenly believe that if they claim benefits early, their benefits will go up automatically when you reach full retirement age. If they or they don't know this is false. The study found more Americans aren't educating themselves about Social Security because they don't think it'll be around when they're ready or need to claim their benefits. That's a pretty large possibility. 7 in 10 adults aged 25 or older worry that the program will run out of money in their lifetimes. This is especially true of millennials, 77%, Gen Xers, 83%, that's me, but even 61% of baby boomers worry about the same thing. In addition, nearly half of millennials believe that they will not get a dime of Social Security benefits they have earned. So, like I said, if anyone out there in the interwebs land has any questions about Social Security, don't hesitate to give me a ring or shoot me an email. I'll be happy to review your benefits with you. And if there's something that I can't answer, I can certainly get you in touch with a benefit specialist who worked for the agency and certainly can get you some good information. So, all right. Next article, Fear and Inflation, the Timeless Policy Tools of Discredited Systems by Matthew Piepenberg. All right. And this was published December 10th. That's today. All right. Diving in. If you're wondering why the media markets and mandates are making less sense despite constant flow of hard facts contradicting their message, it's critical to watch what is done rather than what is said by policymakers behind the fear and inflation new normal. The latest Fed speak translation from transitory to persistent inflation. To the extent that there's anything exciting about a cornered Jerome Powell, he was at least able to drop some bombshells at his November 30th meeting before Congress, including a truly cutting-edge observation and fear that inflation forces are more persistent and that it's now time to retire the word transitory regarding the same. Well, Jerome, we could have told you that long, long ago, but of course, but this, of course, is no shocker. More taper talk, distraction. Perhaps more exciting was his not-so-subtle announcement that the Fed plans to begin a discussion at its next meeting to accelerate the Fed taper by a few months. Despite the fact that any Fed taper will, in substance, not be a taper, given backdoor liquidity tricks from the standing rep facility and FEMA swap lines, the optics of such continued taper talk will be negative for most all assets saved for the U.S. dollar, the VIX trade, and so-called safe haven treasuries, and possibly gold. Bitcoin troubles. Needless to say, Bitcoin didn't respond too well, dropping 20% in the wake of Powell's doublespeak. As of this writing, it rose by 9% in less than 24 hours. Such dramatic price swings, in our opinion, confirm that cryptos, despite consolidation and adoption pains, will never be stores of value, but rather volatile and, yes, exciting speculation assets. Though we know that crypto circles who will likely ignore recent warnings of quantum hacker risk will strongly disagree. I wouldn't say I strongly disagree. I think that crypto is the future of currencies, around the world. So, and they can't be, well, not that they can't. Most, like in example of Bitcoin, you can't ever increase the supply, so it's fixed. All right. The treasury market's bigger problems. Longer term, however, there is a very good reason to worry about the 22 trillion treasury market should the Fed begin reducing portions of its 80 billion per month of UST support in a backdrop of steady and now undeniably persistent inflation. As we noted elsewhere, the treasury market with less Fed accommodation is not nearly as liquid as the Fed would otherwise wish you to believe. In short, if stocks and bonds begin to fall in concert, it's likely such malfunctioning of an otherwise rigged security market will get harder to contain without quick reversal of the forward-guided taper strategy signaled by Powell. Even the best rated corporate bonds lost 2% in the last 60 days as sell-offs continue, pushing yields up as dollar liquidity in the C-suites gets harder to come by. For now, of course, everything about the ever-supported and hence ever-rising rigged stock market is a screaming indicator of record-high overvaluation by every metric. As the chart below confirms, the S&P is at a historically record-breaking red zone of overvaluation risk, kept alive solely by favorably green zone Fed support and hence repressed yields, cost of debt. Do you see how important the accommodated bond market is to the equity market farce? Do you see how debt and debt alone is what keeps the failed system running? So as you can see here in this chart, most of these asset classes are quite a bit in the red. So it's, in my opinion, I've been saying for a while that the market has been overheated. I said this prior to COVID that we, probably could expect some sort of a recession or some sort of a market correction, going into 2020. Well, it happened. Unfortunately, the Fed bailed out all the malinvestment with way too much money, and now we're going to have to deal with those repercussions. So, all right. Well, this is a pretty long article. I'm going to go ahead and stop there. This was probably the most important thing I wanted to share with y'all. Please go ahead and read it. It'll be attached in the show notes. All right, let's go ahead and go to the last article. The money supply growth is slowing. That points to a slowing economy. This was published 12/8. That was Wednesday by Frank Showstock. All right, let's dive in. According to popular narrative, the role of the central bank is to navigate the economy along the so-called path of economic stability. By this way of thinking, if various shocks cause the economy to deviate from its path, then its role of the central bank policymakers is to offset these shocks. This is done by means of suitable monetary policies. And in line with this way of thinking, to counter the shocks from COVID-19, the central bank, the Federal Reserve, pumped a massive amount of money into the economy. This is depicted by the increase of the Fed's balance sheet from 4.2 trillion in January 2020 to 8.5 trillion by October of this year, an increase of 102% or 102.7%. Because of this massive increase, the Austrian money supply measure climbed from 5.8 trillion in January of 2020 to 9.59 trillion by October of 2021, an increase of 81.6%. Conventional thinking would suggest that with more money in their pockets, individuals are likely to increase their spending through the magic of Keynesian multiplier. The rest will follow suit. By this way of thinking, increases in money supply enable individuals to accommodate increases in their demand for goods and services. It's also held that in response to this increase in demand, producers will likely to oblige by raising supply through increase of goods and services production. What we have here is that demand creates supply. Well, not really. Note that in a free, unhampered market economy, individuals pay with goods in their possession for unhampered market economy. Individuals pay with goods in their possession for the goods they require to maintain their lives and well-being. For an individual to be able to secure something, he must have something else. Individuals are trading goods and services for other goods and services. Note that the trading is also present in goods and services for future goods and services. The role of money in all this is, among other things, is to facilitate trade. Money emerged as a result of the fact that barter could not support the market economy. The distinguishing characteristic of money is that it is the general medium of exchange. Money enables one producer to exchange his produce for the produce of another producer. The means of payment are always goods and services, which pay for other goods and services. Thus, a baker exchanges his bread for money and then uses the money to buy fruits. The baker pays for the fruits not with money, but with the bread produced. Money allows the baker to make this payment. Also, note that baker's production of bread gives rise to demand for money. By demand for money, what we really mean is the demand for money's purchasing power. After all, individuals do not want greater amount of money in their pockets, but a greater purchasing power in their possession. On this, Ludwig von Mises wrote, the services money renders are conditioned by the height of purchasing power. Nobody wants to have in his cash holding a definite number of pieces of money or a definite weight of money. He wants to keep a cash holding of a definite amount of purchasing power. Yeah, I mean, so, I always point back to Weimar Germany back in the 1920s. They inflated their economy to pay off the debts from the First World War. And so, yeah, you might have had a lot of money in your pocket, but if it's not worth anything, I mean, it doesn't really do anything for you. And I think that's probably the biggest issue with the Keynesian way of looking at, just the money supply and the economy. They look at it in a very backwards way where supply equals demand as opposed to really demand is driven by wants and needs. And, the more things you accumulate, the more wants and needs you might have. And so that's truly what, if I'm in need of someone to type up letters for me, I then hire someone to do that task. And, in exchange for them typing letters, I then hand them cash, which then they use to then buy food, whatever. All right. In a free market, in a similarity of goods, the price of money is determined by supply and demand. Consequently, if there's less money, its exchange value will increase. Conversely, the exchange value will fall when there's more money. Within the framework of a free market, there cannot be such things as too little or too much money. As long as the market is allowed to clear, no shortage of money can emerge. Consequently, once the market has chosen a particular commodity as money, the given stock of this commodity is going to be sufficient to secure the services that money provides. Hence, in a free market, the whole idea of optimum growth rate of money is absurd. So, all right. So let's see here. Was there anything else I wanted to dive down on? It's a pretty long write-up, so I'll go ahead and just stop there. I've been mumbling for 12 or 20 minutes now. So, but like I said, it's the problems we're experiencing today are simply because of the increase of money into the system over the last year plus, and then the inflation that we've experienced over the last, say, 20 years is a product of, interest rates being held at such low rates for such a long time. Eventually that bubble is going to pop, and, things are then going to, swing the other way and then eventually normalize. So, we'll see what happens. Most of us are kind of powerless at this point. The government's a big behemoth. It just does what it does. And, whether or not it collapses in the next couple of years, or we have a new system of government, people come to their senses and try and start this thing over, we'll see. So, all right. Well, that's everything that I had for this week. If there's any questions or concerns or something that you'd like me to talk about next week, don't hesitate to shoot me an email. Here, let me put my email address up there if you want. And then I'll be back on Monday with the weekly economic update. And everyone have a fantastic weekend. We're expecting beautiful skies, and little wind is expected, but nothing that's out of the ordinary for living out here on the Front Range. So have a good one, and I'll be back on Monday. Bye-bye.